I do, and in fact, I think you said the words that I would have otherwise said, Sarah, and that is to say the economy remains very strong. The corporate earnings picture remains bright, even though we expect earnings to decelerate over 2019. Year-over-year estimates are still in the low double digits. And so while I don't think we're going to necessarily see multiple expansion, and I do expect the ride to be bumpy, at the same time, I expect earnings to deliver stock share price gains that are likely to be better than bonds and cash.
Yeah, Mark, that all seems to fit together. I do wonder, though, and I think increasingly as the market kind of behaves this way, it kind of raises the question of what is the market trying to suggest when you see so many of these, even consumer cyclical sectors underperform so much, when there is a defensive turn in the overall market. So is that just kind of, a stutter step in the uptrend, or is it, a moderation of economic growth that it's trying to suggest?
Mike, I'm believing it's more the former than the latter. I was looking at some charts just today, and if you look at the year-to-date results of all 11 GICS industry sectors, it kind of fits the eye relative to economic conditions overall. It's not perfect, but nonetheless, you have your pro-cyclical sectors that are up decently, still led by healthcare, but nonetheless. But if you look at it since basically the first week of June, it looks much different, and it's all defensives all day long. And I think we've seen this play out time and again historically in midterm election cycles where you have the staples, the telecoms, the utilities, and healthcare lead for about 5 months prior to the election, and then post-election you have a rather steep rally into year-end through the first quarter of 2019, in my view, from here, which I think is going to be highly cyclical in nature, and therefore I don't want to be trapped by chasing these defensive names at this juncture.
Mark, it's Evan Newmark. Everything that you said makes sense in what we'd call a normal economic cycle. But given that we are now in the quantitative tightening or tightening phase, post-Fed easing, how do you overlay everything that you just said with that? I mean, traditionally we look at patterns. Mike and Sarah were on with somebody in the previous hour. They were talking about, oh, the charts say this, the charts say that. A lot of these charts were not built or were not developed during periods of tightening. Do you have some overlay over everything that you just said that tells you to do something or the other?
Evan, I do. The one I just mentioned is basically the business cycle. And obviously, while we may be late in the economic cycle, underlying fundamentals remain very good for the economy and for the foreseeable future. The other is the monetary cycle. And right now, the settings are still accommodative. We looked at 4 phases of the monetary cycle. Obviously, the best one for equities is when we're easy and easing. And the Fed clearly is not doing that, as you just mentioned. But Evan, in the cycle in which we're still below what the Fed estimates to be the neutral rate, which we know that to be the case, again, to the extent we can believe the Laubach-Williams model suggests the neutral rate is above where the Fed funds rate is today, and even while tightening, that's still the second best phase for equity prices, in which the compounded annual gains are still quite attractive, and again, more attractive than that which we would expect to see from bonds or cash. Since I don't expect us to reach that neutral rate until probably toward the end of 2019, or perhaps even beyond if the neutral rate moves up further, then that ought to be a pretty good playground for equity prices over the next 12 to 15 months.